Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, first and foremost, get the trade. On your screen is what we call our advanced get dashboard. Now, what this is designed for is to help you identify where the trades are located. We can set this to any one of our strategies, whether it's false bar stochastic, type 1, type 2, XTL. This will help us find the trade. Now, I've got the 6 popular currencies on here and the ones that ISE trades options on: the euro, the pound, the Canadian dollar, the Swiss, the yen, and the Australian dollar. What the dashboard is doing, it's coming back and telling me on a particular time frame, are there any potential type 1 trades? Now again, we can set the dashboard to type 1s, type 2s, any one of our strategies. For instance, on the 60-minute chart, when I took this screen capture, we've got a 60-minute gauge that's turned red. That means that the 60-minute chart of the euro is in a possible selling opportunity. If we look down the list, we have a 60-minute chart of the Swiss franc as a green gauge. We've got a potential type 1 buy on the 60-minute Swiss. If the gauges are yellow, that means you have no trading opportunity. If you have no type 1 strategies, you can go back to your dashboard settings. It just takes a quick click, and go to your type 2s and see if you have any trade opportunities present. Now, because we're looking for very specific strategies, you're not always going to have a trade available. That happens. There's nothing wrong with shutting your computer off and not making a trade. As a trader, as an analyst, you have to be okay, you have to have the discipline to look at your screen, realize that there's no trading opportunities present right now, and turn it off and go do something else and wait. As a day trader, let me tell you how frustrating that is. There's nothing more frustrating than sitting in front of your computer for 7 to 10 hours and not taking a single trade. But as part of a disciplined mechanical trader, that does happen occasionally, and there's nothing you can do about it. You just don't trade when there's no patterns available. So when I look at this screen, I only see 2 trading opportunities present. That doesn't surprise me. We're looking for very specific, very pristine patterns. Now, if the dashboard appears and the dashboard actually gives me a trading opportunity, I take a look at the chart. This is an example back from September 22nd or so of the Swiss franc. This was a type 1 sell. Now, with the Elliott type 1 trade, there's 4 distinct rules that must be followed. Rule number 1. Now, this is mechanical, and we cover this in our education, and we cover this in our user manual. Rule number 1. Elliott wave 4 must be the last labeled wave on your chart. Now, one of the nifty features of eSignal Advanced Get is we can go back into replay mode and also tick replay. So we can practice. We can go back 3 or 4 weeks from today, and we can look at the chart and go through it bar by bar by bar and see how the trade played out. It builds practice. It builds discipline. So I've done that on this chart of the Swiss franc. Back on September 22nd or so, the market had an Elliott 4 as its last labeled wave. This is the first signal that we have a possible type 1 trade. Rule number 2, and again, these are mechanical rules. If they're not in place, we don't take the trade. Rule number 2 deals with this PTI right here. That PTI is what we call the profit-taking index. This is a proprietary study to Advanced Get developed back in the 80s. The profit-taking index, what it's going to do, it's going to compare how much price the market took in Wave 3 compared to how much we've given back in your Elliott Wave 4. If we haven't retraced and we haven't given too much price back, that profit-taking index will be a larger number. Now, The limitation of the profit-taking index, the number that we're looking for, is 36. It's got to be 36 or higher. If it's below 36, if it's 35 or lower, the market does not have a good probability of making new lows. Now, at the end of the day, what we're shooting for with this pattern on the Swiss franc, we are looking for the market to come down and make a new low. If that PTI is 35 or less, that means you have a poor chance of making a new low. So why would you trade it? It's all about finding predictable patterns. If there's no predictable pattern, you don't trade it. Now, on the flip side, you may say, well, if that PTI is only 30, why wouldn't you try to buy it or maybe get a call? Because we don't know what the pattern will be next. The market is unpredictable. We're only looking for predictable markets. Unpredictable markets get passed, and we go look for something else. So the market may rally from here if the PTI was 35 or less. It may go sideways. It may decrease in value a little bit. It's unpredictable. We don't want to trade unpredictable markets. All right, so we've got two rules so far. Elliott Wave 4, what you see right here, and our profit-taking index, 36 or higher. Now, why 36? Why isn't it 25? Well, it's about backtesting. Backtesting and looking at these patterns showed us that 36 is really the median value. We noticed that there was really no difference in accuracy if we got to a 70 PTI or a 90, but 36 was really the cutoff. Lower had a statistically lower chance of completing a fifth wave. 36 and higher had a better chance of creating a new wave 5. So it's all about the backtesting. Rule number 3 has to do with this oscillator that you see at the bottom of your chart. Now, the oscillator is not really a complex indicator, but the way that we look at it, it's hard to describe over a telephone presentation. But what we're looking for is that oscillator to essentially pull back to zero. I'm just going to draw a very quick line, and let me change it to black here. What I mean by zero, if you were to look at the midpoint of the oscillator, the axis, right about, try to get it perfect here, where that black line I just wrote in there was. During an Elliott Wave 4, which is what this market's in right now, oscillator, the Elliott account is identified as a Wave 4, we're going to go back to our oscillator, and we want to make sure the oscillator is at or near zero. Now, when you get the program, or if you've been trading with a Type 1 trade, there's actually a specific measurement that we look for, a 90 to 140% pullback. But like I said, for today, let's just keep it simple. We're looking for that oscillator to return to zero. So what we've got here is we've got a nice big long wave 3. The Swiss was in a downtrend from July into mid-September. The oscillator was very weak. It went well below zero, found its lows in mid-August, and then the market started getting a little bit stronger, and the oscillator starts moving higher and higher and higher, and right here, right around September 19th through the 20th, the oscillator returns to zero. That is your clue that Wave 4 is now officially confirmed, that oscillator pulling to zero. So we've got 3 rules so far. Rule number 1, Elliott Wave 4 is identified on your chart, and it is. Rule number 2, profit-taking index, 36 or higher. Our PTI is 63, rule has been met. Rule number 3, our oscillator has to be pulled back to zero, and it is. On that day of September 22nd, the oscillator reaches zero, and this Elliott Wave 4, for the most part, is now confirmed.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.